In today's episode, I'm going to teach you 3 different trading strategies for how to make money during a bear market. The first is a long-term investing strategy. The second is a shorter-term swing trading strategy. And the third is an ultra-fast day trading strategy. But before I get into breaking down the ins and outs of where to buy, where to sell for each of these strategies, let's get some facts straight and bust some of the myths and misconceptions about market corrections and bear markets. So over the last 100 years, there have been 56 market corrections. So in other words, a market correction happens pretty much every other year. But on the news, all you hear is the fear mongering, which they put out to get the clicks and get people's attention, that, oh my gosh, the market's in a correction. In fact, it's nothing to fear. This happens every other year. So what is a market correction? A market correction is when the market drops 10% off the all-time highs. So we've had 56 of them over the last 100 years. And they last an average of about 4 months before the market is back at the highs. Now, 22 of these corrections turned into a bear market, which is when the market pulls back more than 20% off the all-time highs. Now, a bear market takes on average about 9.6 months to recover. So as we sit right now today, the market is down 17.64% off the all-time highs. Now, as you may know, the catalyst driving the sell-off in this current correction, and we're currently in a correction, is economic policy regarding tariffs. So this is a policy that could be stepped back, it could be unwound, and the market most likely would go right back up, or it may be a policy that stays into effect and we continue to see a decline in the market. So if we go into a full-on bear market, which is possible that we will, I think what's important to know is that a bear market is not something to be feared. In fact, a bear market presents some unique opportunities to make money that are simply not present during a bull market. You may know that Warren Buffett has been sitting on over $300 billion of cash. He's sold out of positions at the top of the bull market and has been waiting not just for a correction, but for a true pullback so he can buy some of the companies that he really likes at a discounted price. So he has the saying of be greedy when others are fearful. So there's a lot of people right now that are fearful. They're selling because they've mismanaged their risk. They're in too high. And so at the slightest sign of weakness, they're all bailing out, where other traders are sitting on the sidelines waiting to jump in. So let's go ahead and get onto the slide deck here. We've got a lot to cover, and I want to start by kind of, setting the stage. This is the overall market as we sit right now. So as you can see, we're at 17.64% at the bottom of the drawdown, and the market is still actively selling off. This was just the close. So we're most likely going to open lower and continue a bit lower tomorrow. The market's been selling off. You've got these high volume red candles. So we're not out of the woods yet by any means. We're really at the very beginning of this correction going into what is quite possibly going to be a bear market. However, over the last 5 days, while the market was having its worst week in over 5 years, I finished up $37,423.31. And that was using some of the strategies that I'm going to share with you today. Now, I say this because I kind of want to lay the stage and give you the context of the person that you're learning from today. Over the last 3 months, I've had one red day, and you may know me, for those of you guys who tune in on YouTube quite frequently, but I turned a small account with $583.15 into more than $12.5 million. And that was as per my audit, which was at December 31st of last year. Now, this year, I've already made over $1 million. So now it's $583 to about $13.5 million. Now, I'm not saying that because I want you to assume that my results are typical, because they're not. But I'm saying it because I want you to know that I've traded through a lot of different markets. I've traded through market corrections. I've traded through bear markets. And so this is nothing new to me. But what I often see here on YouTube are a lot of traders asking the question of, Ross, how do I trade during a bear market? And does your strategy still work during a bear market? Do you still make money? And the answer is yes, I do. So let's go ahead and jump into our first strategy. The first strategy, high level, is a long-term investing strategy. So investors, especially beginner investors, are often very nervous during the beginning of a bear market, the beginning of a market correction. They pull out of the market quickly, but this is often the result of mismanaging risk. So unfortunately, what a lot of investors do is they're self-directed. So they'll buy shares of companies in their accounts all by themselves. They're not using a financial advisor. And so at the slightest sign of seeing the position start to decline, they're going to start selling. And for some of them, they're locking up profit if they've been holding for a while. But for others, they're taking losses. Now, a lot of, unfortunately, amateur investors will also invest on borrowed money. So if you're investing on borrowed money, which is the use of leverage and margin, then you really can't afford to hold if it starts to go against you, because your borrowed money, which is the bank's money, they're going to ask for their money back, and you're going to get what's called a margin call. You're going to be locked out of the position. So nobody wants that to happen. So what ends up happening ultimately is that during a bull market, there's an excessive amount of buying as people are basically succumbing to greed and the emotion of not wanting to miss out on these market gains. So they buy and buy and buy, oftentimes on leverage. So they're using borrowed money. And then when things start to pull back, they pull out of all that money. And so you get these big sort of run up and then these big dumps as the market pulls back. And so that's what amplifies the volatility in the market. However, there is opportunity to profit from that heightened state of volatility. And that's what we're going to be walking you through here. So for me, one of the things that's really helped me is to always look at the downside risk of my long-term investments. And just to give you a personal example, during the pandemic in 2020, 2021, we ended up going through this period, especially in 2022, when the Federal Reserve increased interest rates, that we went into a sustained bear market. So if we pull up our chart of the S&P 500 here, I'll show you 2022. So S&P 500, we're going to switch to the daily chart. So we go back to 2022. I'm going to put it on auto. This was our bear market right through here. We pulled back. This was our peak. This was the bottom of the drawdown. So this was substantial. And during this period, all of my long-term investments decreased in value, as you would imagine. But what a lot of long-term investors do is we diversify by investing long-term in equities, but also investing in bonds. Typically what happens is during a recession, what does the Federal Reserve do? They decrease interest rates to stimulate more spending. They're not worried about inflation like they are now. They want to get the economy going. So they want to encourage spending. When they decrease interest rates, all of the value of your current bonds, which were locked in at a higher interest rate, go up. So while equities are going down, your bonds are going up, so it offsets that loss. But in 2022, equities went down, and then the interest rates went up, so the bonds went down. So you got a double whammy of really no safe haven. So during that time, as I was watching my accounts go down, I realized, I really don't like the way this feels. I don't like seeing my long-term Roth IRA, which I've worked so hard to grow, decreasing in value on both the bonds and the equities. So at that time, I said, you know what? I can't do anything about it now, because the worst thing to do is to sell at the bottom of a bear market only to watch the market rally back up. So what history told me was that this bear market will recover. It's a matter of time. 9 months, perhaps, maybe a little longer, maybe a little shorter. But I said, when it recovers, when my account gets back up, I'm going to reallocate my risk. So I reduced my risk. So the next time we have a bear market, my account won't go down 25%. It'll only go down 12%. So that means adjusting your risk. And so if you're in a position right now where you feel overexposed on your long-term investments, that may be a time for you to say, all right, the next time the market comes back up, I'm going to do a little bit of shift in my allocation. There's a lot of people, for instance, in the dot-com bubble or in the 2008 financial crisis, that had their risk totally mismanaged, where they were too heavily invested in the equities market. And then all of a sudden you get this big market correction down 30%, 40%, and they're not prepared to ride out the recovery period, especially if someone is in retirement when this happens. So it's always important to ask yourself, what is the downside risk of these investments? And am I truly comfortable with holding through the bottom of that drawdown? And if you're not, then you got to adjust your risk to reduce your risk. Now, if you already have companies that you like, a correction or a bear market can be an opportunity to buy those shares at a discount. Be greedy when others are fearful. That's the Warren Buffett quote. That's one of the quotes he's very famous for. So corrections, bear markets, and even recessions can provide unique opportunities for savvy investors to generate exceptional returns. So let's talk about some of the unique opportunities during a bear market. Now, during the 2008 financial crisis, just for instance, there were a number of stocks that did exceptionally well. While it's true the overall market was down, there were certain stocks that did well. What were some of those stocks? Dollar General, Dollar Tree, Walmart, McDonald's, AutoZone, Budweiser. Those are just a few. That's just a handful. That's 6 or 7. Now, why was it that those stocks did well? Well, as it turns out, during recessionary times, when people sort of tighten their belts when it comes to spending, the discount stores see heightened sales. So they make more money. So your Dollar Tree, Dollar General, Ross stores, And then Walmart, of course, they made more money. AutoZone, people are more inclined to fix an old car than buy a new car. So they did well. And Budweiser, well, there's a correlation that people buy more alcohol during recessions. There's also a correlation that during the pandemic, Netflix did very well. A lot more people were at home watching Netflix. A lot more people were subscribing to Netflix. So there were some specific stocks that were a safe haven. Now, as always, past results are not indicative of future results, but we can develop this understanding of the inverse relationship that certain companies have with the overall market. So a really strong economy, while that can be really good for some stocks, a weaker economy can actually be better for other stocks. Now, typically, treasury bonds are a safe haven, but right now, given our higher interest rate environment and the likelihood of interest rates staying at the current levels for some time, I don't think that there's an opportunity there. Gold, as you know, gold is at all-time highs. Gold ETFs are very common. A lot of people move their money into gold during corrections, bear markets, and even recessions. And then the third thing, or the third item on this column, is cost basis averaging on existing positions. And I'm going to get into more detail on that in just a moment. So this is the stock chart of McDonald's. Overall market's down 17%. McDonald's more or less flat. It's down a little bit, but not too much. There's Dollar General. Market's down 17%. Dollar General's going up. That's what we would expect. Here's Walmart. Now, Walmart's dipping down a little bit, but because of their exposure to tariffs, right? So the cost of goods are going to go higher there because of so much that's imported from overseas. AutoZone, they're doing pretty well. I think they import quite a lot from overseas as well, but they're doing pretty well still. This one was a Budweiser. I got to update the title. So Budweiser here, overall up quite a lot this year. So that's good to see. Now, the way to take positions for long-term investing. So for strategy number one, my preferred method is cost basis averaging. It's very difficult to perfectly time the market. And so the easier approach for most beginner investors is adding fixed dollar amounts of money at regular intervals. That's called averaging into the position. So if it's adding $100 a week or $100 a month, it doesn't matter, but you add the same amount of money at regular intervals. So when the market is having a correction or a bear market, that fixed amount of money will buy you more shares. So it helps bring down your average a little bit. And so you kind of bring down your average. But of course, when the market's higher, that same amount of money buys less shares. So you're doing cost basis averaging. You're adding a consistent amount of money at fixed intervals, and over long periods of time, you're going to find more often than not that you do well, as long as you're making sure you're picking the right companies. Now, if you're not sure about how to pick individual companies, you can always go on the safe side and choose an ETF like the S&P 500, which is an index of 500 of the largest companies essentially in the world. So now you're diversified. Even if one of those companies goes bankrupt, you've still got the others that offset the loss on that one. So one of the safer, more defensive approaches is to do cost basis averaging on an index like the S&P 500. This does require an ability to form an opinion of the fundamental analysis of an individual company if you're going to choose specific companies, but it doesn't require you to understand complex technical analysis that you probably have seen me talk about quite a lot if you've watched other episodes here on YouTube. Now, by the way, those of you guys who are tuning in for the first time, I hope you hit that subscribe button. I hope you're already finding value and enjoying this episode. Those of you guys who are coming back, you know that we're diving deep today, so I hope you hit the thumbs up for today's class. Now, the second strategy I want to talk about is swing trading. So a swing trade, in contrast to a long-term investment, is something that you buy with the intention of selling it fairly soon, possibly within even just 1 to 2 days, but maybe just a few weeks. So a swing trade is a short-term position, and typically traders will put larger amounts of money into this shorter hold time. They're offsetting their risk by holding for a limited period of time. You want to avoid holding during an earnings event when a company is putting out earnings. And you can always check a company's earnings calendar to know when they're going to come out. So you got to be a little bit careful when you're holding, but you diversify you reduce your risk by holding for a short period of time, but then traders often increase their total capital so they can profit from a relatively small move in the underlying asset. However, during times of market corrections and even bear markets, the heightened volatility can give amplified returns during these short windows of time. So I want to talk about UVIX, and SVIX. So these are both financial instruments that are very common to trade, And UVIX goes up when the VIX goes up. The VIX is the volatility index. It's predicting the amount of volatility over the next 30 days in the market. So during times of heightened volatility, the price of the VIX goes up. During times of reduced volatility, the VIX goes down. So one of the things that we know is that a lot of long-term investors and big investors investing for institutional banks and hedge funds and stuff like that will purchase shares of the VIX as a hedge. So they know they've got a really large long-term position in equities, and if that drops, they purchase the VIX so it at least helps offset the loss. Now, the interesting thing about the VIX is that when it goes up at a far greater ratio than the overall market goes down. So they're essentially leveraged moves. So if the market goes down 1 point, for instance, the VIX will probably go up 5 points. So you get these much bigger swings, and that allows you to buy a technically smaller position and still make just as much money as you might be losing on a larger position that's dropping on the overall market. So that's why the VIX is a popular instrument for hedging. Essentially, it's an insurance play. And so the VIX is not meant for long-term holds, but during short periods of heightened volatility, you can get large returns. So UVIX, this is trading the VIX to the long side. This has gone up over 100% in 2 days, from $30 all the way up to over $76 a share. That is a remarkable move. I mean, this is truly impressive. So this is the type of swing trade where if you see something coming out in the market, and it does require you to be dialed in on economic data and certain announcements that are coming out from, the foreign politics and, the trade stuff and everything else. But if you see that the market is starting to drop, this can be an opportunity to ride that momentum. Now, you could short the overall market, but if you shorted the overall market, you would, let's say the market drops $1 a share, you make $1 a share. Whereas if you buy the VIX, you're getting $5 a share. So rather than shorting, most people would instead trade a derivative, which would be to buy or sell options, buying calls or puts, or trading the VIX. Now, the problem with buying calls and puts is that if they're out of the money, they'll expire worthless. So it's kind of like an all or nothing type of strategy when it comes to options trading, which is very complicated for beginner traders to understand. So a more simple approach is either to simply buy UVX, UVIX or SVIX, or to trade, in fact, the underlying asset of the S&P 500, although that would require short selling, which requires a margin account. Now, SVIX has been dropping because it's a short on the VIX. So when the VIX goes up, SVIX, short VIX, goes down. So that's a little confusing because this went down from $20 to $12 over the course of 2 days. So yes, it's volatile, but if you would make more money if you bought UVX, UVIX versus shorting SVIX. However, what some people will do is if they're restricted from being able to short stocks, when the market starts to bounce and go up, the VIX will drop. So now this ETF, which is shorting the VIX, is going to go up with the market. So this is trending down with the market, and if the market goes back up, this will go back up. So rather than trying to short UVIX, which most brokers will prohibit because it's too volatile, traders will switch to trade SVIX. That's why it was created. And for what it's worth, anyone trading in a retirement account, tax-deferred IRA or Roth IRA, you can't short at all. So now you have these instruments like SVIX that you can buy, which essentially profits as something else goes down. So it gets a little bit complicated, but what you really have to understand is the simple relationship that when the overall market goes up, the VIX goes down. And so rather than trading the overall market, we're trading the derivative of the VIX, and then we're trading these two versions of it, which is one that's short and the other that's long. So the way to take positions when it comes to swing trading, the best way is for you to understand the basics of support and resistance. So when you understand support and resistance, and you're going to understand these based on historical prices, where an instrument has shown clear support or resistance in the past, you're going to see the support level, and you're going to use that as your max loss. So you try to get in as close to support as possible, because if a stock or ETF or whatever it happens to be gold, if it breaks below support, that's the exit point. So the closer you can get in with an entry at support, the lower your risk. So if we jump onto the whiteboard here, so let's just say we've got something that's been going up and then pulled back and came up and pulled back and came up. If you were trading something in this range right here, this is clearly support right down there. So while you could buy it right here, you'd be kind of buying right into resistance. So it would make more sense to come down here and buy right there with a max loss right here, and you can set a live stop order on that trade, and then wait for the recovery back up here, where you could choose to either sell or hold to see if it's able to break through this level. Now, something that's worth noting is typically when you get a break, the market will come back, retest that level, and then if it holds, then you're good. So if it broke to the downside, it would typically come back up, retest it, but if it fails, then you go lower. But if it can reclaim it, then it actually is a recovery. So nonetheless, it's important to get in as close to support as possible and then set your stop just below support. That way, you know you're essentially getting the best risk to reward ratio on that trade. So the best trades and the best entries are as close to support as possible, the max loss stop order set just below support. Now, taking swing trades requires an ability to read candlestick charts and perform technical analysis and understand the different types of orders, stop orders, limit orders, so on and so forth. Don't worry, more on that coming soon. Now let's talk about day trading. So when we're day trading during a correction or during a bear market, our focus is on trading the instruments today that are highly volatile. So there are two essentially sub-strategies for day trading. The first is trend trading, where you're buying stocks or instruments that are moving up and shorting stocks moving down. And then the second is reversal trading, where you're buying weak stocks, looking for them to bounce, or you're shorting strong stocks, looking for them to reverse. In all of my years of trading, I have found far more success trading with the trend, both in short-term swing trade and long-term, than I've ever found trying to do reversal trades. So I'm an advocate of trend trading. Now, the way I find stocks that are moving are by using my scanners, as you can see right here. So this is my top gainers scanner showing me the leading gainers in the entire market. This was yesterday. So this was on the day the market was having its second worst day in 5 years. And there was a stock up 393%. Now, there were also the top losers, but the biggest stock, the biggest loser, was down 32%. So when you think about this, which is more powerful? A stock dropping 32% and trying to profit off that move, or a stock going up 300% and trying to profit off that move? A 300, 400% move has a lot more opportunity. And notice the volume. 81 million shares of volume. 114 million shares on the second leader, which was up 100%. How much volume on the stocks that were dropping? 2 million shares? 1.5 million? There's not a lot. So clearly, especially in a bear market, people don't have as much interest trying to chase the stocks that are dropping, and they also don't have as much interest in trying to time the reversal. Why try to pick the reversal point on a stock that's obviously extremely weak? It just doesn't make sense. And so yesterday, Friday, just for instance, this is the stock that I did quite well on, AREB. So AREB, we get this incredible move on this early in the day. The stock goes from $5 a share all the way up to over $20 a share. Incredible. It peaked at well over 400% on the day. And on this stock, that stock alone, I locked up over $20,000. So this is my profit right here from Friday, $20,523.24. And that was while the market was selling off. So what was the trick? The trick and how I took that position was first finding a stock that had that heightened volatility. Okay, it's finding a stock that was moving and then performing the technical analysis, getting into that chart pattern and actually trying to understand where's support, where's resistance, and how can I manage my risk on this trade. Now, day trading is highly technical. We use technical analysis, but we also use live market data feeds to interpret buy and sell strength based on the current orders that are coming through the market in real time to buy or to sell. So that's not something that you really need to get involved with when you're long-term investing. And it's to a lesser extent when you're swing trading. When you're swing trading, you don't need to subscribe to market data because you're going to be holding for days. So it doesn't really matter the current order book of how many people are trying to buy or sell right now. You're basing your trade on a longer-term chart pattern and a longer-term thesis or an opinion that this stock is going to go higher. And maybe you're even going to do some cost basis averaging where you're planning to add a little bit of money each week and hold it for a couple months. That could still be considered a swing trade. It's not an investment is generally something you're going to hold for like more than a year. So a swing trade can be short as a couple days, but it can be weeks or even months. So when you're long-term investing in swing trading, you don't need to perform as much technical analysis, and you certainly don't need to get into details of reading the level 2 or reading the tape. But when you're day trading, when you're trading in a very, very short window, and on a stock like this, I mean, goodness, this stock went from 4 all the way up to 6, 7, 8. It pulls back, it rips back up, it dips down, it rips back up. I mean, even right here, look at this drop from 19 down to $10, and then it rallies all the way back up to 20. This is highly volatile. So to be able to make accurate predictions about what this is going to do over even just the next 5 minutes, you need to use every piece of data at your disposal. And so what I'm doing in my own strategy is I'm using technical analysis, which is reading candlestick charts. I'm using my technical indicators on the charts. I'm reading the volume bars, and I'm also reading the level 2 market data so I can truly understand the sentiment behind the stock. Now, these are the 3 high-level strategies that I've used to make money during bear markets: long-term investing, swing trading, and day trading. Now, if you want to learn more about how to perform technical analysis, I'm going to put a link to an episode right here. And if you want to learn more about how to start day trading, I'll put another episode right there because those are the most complex. Now, if you want to check out an episode on long-term investing, I take the approach of investing in dividends because even during bear markets, even during the Great Depression, the dividends still get paid out. So I hope you guys really enjoyed this episode. If you did, I hope you hit the thumbs up. I hope you're subscribed to the channel, and I will see you for the next upload real soon. Reminder as always, trading is risky. My results aren't typical, so please manage your risk, take it slow, and I'll see you real soon.